So welcome to the first lecture for your financial reporting, a big journey with respect to the whole subject of financial reporting, friends. You would have studied accounting standards in your intermediate or IPCC if applicable, wherein you would have just got an insight with respect to the accounting which is there in our corporate world. That what accounting we learnt, of course that was nothing wrong from 11th, 12th and all those areas with respect to a sole proprietor, a partner. But as you moved further, you were exposed to accounting standards where complexities of accounting, resolution to those complexities, and all those things were there. Now the next level, when I say financial reporting, paper 1, friends, I can say it is IND AS. Of course, but all this IND AS end up with reporting. But your whole syllabus is particularly focused on IND AS only. All the chapters except one are IND AS based chapters. They're all IND AS only. So we are going to study IND AS. Of course, whatever you studied in AS, that still remains for many companies in our country. AS are still applicable, but to many of them, like listed, process of listing, who have fulfilled some criterias, to them IND AS is applicable. So we'll be learning each and every IND AS, which is nothing but a chapter in itself. You can see that we have bifurcated our videos also based on that. Within videos, we have done module bifurcations, within modules, sub videos, and many things. So dear students, let's start with introduction to financial reporting and the second area, which you had in your intermediate chapter, and you also had somewhere in foundation also, but very important that I will be doing it here. Of course, from CA final angle you will say, sir, is that required? From examination point of view, no, not required. But for understanding many of the IND AS, this is very important framework for preparation and presentation of financial statements. Many chapters, I'm sorry, many IND AS, intangibles and all those things, where some definitions would be there. Asset, liability, expense, incomes. What are they? The basics are covered under framework. From there we take up the definition and we identify whether that will be an asset or an expense or an income or a liability. Okay, so I have gone for that stuff here. Yeah, that framework for preparation of and presentation of financial. So two things we are going to study here. First, the introduction to financial reporting, and thereafter the framework. Now friends, what is financial reporting from your angle? Basically nothing but reporting what? Financial transactions of the corporate entities. These are this corporate entities: joint stock companies, banking companies, insurance companies, and non-banking finance company. Nothing but this subject deals with reporting of financial transactions in financial statements of corporate entities. Now see what has happened across the globe. Many of you would be coming across the word IFRS, IASB, FASB, US GAAP, gap, that is Indian gap, and many things. Let me go one by one. The seeds with respect to having certain set of rules, certain set of procedures, certain standards were sown 100 years back by New York Stock Exchange. New York Stock Exchange brought some rules, regulations for all those companies which were listed on that stock exchange, that you need to prepare your financial statements or whatever accounts by following those set of rules, practices, certain assumptions, certain conventions. So standardization was made. Thereafter, it was in London Stock Exchange wanted that way. Coming to our country, friends, it was Accounting Standard Board which was set up by ICI in 1977. So in the late 70s, of course our ICI was formed in 1949. But in late 70s, they also felt that in India, with the structure of business, which was predominantly sole proprietor and partnership, was venturing into corporate. The business structure was corporatized. Companies Act was made. So many business people were having their businesses run through joint stock companies. Banking companies were formed. And as a result, the whole fundamental of reporting became very important. Because there was a separation in the management and the owners. When it was a sole proprietorship, obviously, you always think in this way that whatever it is mine, whether I have that information, I don't have information. If you recognize sales today or you recognize after 3 months, it doesn't matter that much when we are a sole proprietor. See, I'm not saying that is correct whenever you record. I'm not making such statement. I'm saying because you are a sole proprietor, you are not answerable to somebody. But when the form of organization went towards company form of organization, you become answerable. And when you became answerable, the point comes, sir, I can present my answer in this way. This person presents the answer in this way. Other person presents the answer in this way. I follow X rule. Other person follows Y rule. And third person follows Z rule. So the user was obviously confused. So there was a need of having certain set of, you can say, rules, conventions, practices, principles, based on which reporting can be done. Books of accounts are to be prepared. This task was taken by our ICI. They formed an accounting standard board, which was given the task of formulating accounting standards for our country. And of course, government also made standards mandatory by making those accounting standards as accounting standard rules. And things were moving on. Accounting standards actually became part of our Companies Act as accounting standard rules. Now friends, slowly, if you look properly, across the globe, you found liberalization, privatization, globalization, all these things happening not in our country, but across the world this was happening. Companies were venturing into other countries. multinational companies were being formed. People were creating resources, mobilizing resources, not from their own country, from other country also. We were never restricted. Earlier, it were closed door economies across globe. So it is not only that our country only went for this liberalization private, but it was the need. You'll find all countries felt the need that we are a small village. And let's remove those barriers of trade. Let's remove the barriers of labor. See, free labor movement also started. Of course, some embargoes are there. But if you compare, those embargoes were removed slowly by all countries. Professionals are well allowed to go from one place to another for giving their services. And this happened. So now what happened? An Indian company was getting loans from Europe. There were some people who were interested in investing in an Indian company. So question arose that we are ready to invest in your company. We are ready to lend you some resources. We are ready to have synergies with you. Let's come together, work together. But for that purpose, they had to understand the financial statements of the counterparty. So, a European lender would obviously be happy to lend it to an Indian company. But then he says, I need to understand what is your financial stability. And there is where the not problem I can say, but conflict started. Because the financial statements in India were prepared based on the laws prevailing in India and of course accounting standards. A UK based company prepares its financial statements based on the standards applicable there. US GAAP. So what happens for an investor who is a global investor feels something referred as ununiformity. He finds it difficult. The principles are not same. And there is where there was a need of having one set, principle based set of accounting standards, which led to creation of something referred as IAS, International Accounting Standards. Which was prepared by International Accounting Standard Committee. They used to prepare this. How we have Accounting Standard Board. Of course, this IASC was dissolved and IASB was formed, which was International Accounting Standard Board. And they started giving some set of standards which were referred as IFRS, International Financial Reporting Standards. Now when they give this International Financial Reporting Standard, this board was very clear. There's unless and until we have an IFRS, the IAS will not be withdrawn. So, say for example, there is one IAS 2 which deals with inventory valuation. So, unless IASB comes with an IFRS which is for inventory valuation, till then IAS 2 will be applied. It means the IAS were not withdrawn. They were never withdrawn. Whenever an IFRS comes, this IFRS, like say for example, IFRS related to financial instruments. The moment IFRS related to financial instruments was made up, the related IAS pertaining to financial instrument stood withdrawn. Similarly, when consolidated financial statements IFRS 110 came into picture, the related IAS stood withdrawn. But the areas which are not covered by IFRS were actually covered by IAS earlier, and still they are covered by IAS. So today friends, when I say IFRS, it is nothing but combination of international accounting standards which are not yet withdrawn and actually the IFRS. So we use a common term. When we say IFRS, then you will find that it is combination of IAS plus IFRS. Yeah, so IAS is nothing but International Accounting Standards and International Financial Reporting Standard. Now this task is now governed by IASB, set up in London, International Accounting Standard Board. But obvious, global leaders felt the need that there has to be a same language of reporting so that an investor will be able to evaluate the companies which are in India, Australia or Europe on the same parameters. Indian government being signatory to it, ICI also agreed on the task that yes, we need to have a single set of reporting standard for the entities in our country also. And there is where ICI came up with IND AS, Indian Accounting Standards. So now dear students, in our country, you will find two set of accounting practice basically are there. One is accounting standards which are followed, and other is IND AS. Now this IND AS, what is this IND AS? It's nothing but converged with IFRS. Of course, majority of the principles you will find are driven from IFRS only. But certain areas we differed with them. That's why we didn't go for ad hoc adoption of IFRS. India didn't go for ad hoc adoption. That whatever is IFRS is there in India. The reason was very logical given by our ICI, and that was the business practices, the law, as far as India is concerned, is different from international practices. Our business rules are different. Our business culture is different. The laws which are prevailing in our country are obviously different. See, today you can say, sir, one nation, one tax. But this all IFRS and IND AS stuff all started way back, 10 years back. At that point of time, there were multiple taxation laws. Each state had its own laws. Excise, service tax, so many complexities were there, which were not present at international level. So, applying IFRS directly on our Indian entities would obviously be detrimental to the interest of our Indian corporates. So what did our ICI say? ICI was of that opinion that we will have our own set of standards which were referred as IND AS. Our own set of standards, but this our own set of standards will be converged with IFRS. And at some point we will differ principally from IFRS, which was referred as carve out. And our terminology will differ. Then we say it is nothing but a carve in. Principal difference are there with IFRS. Carve out. It's not, you can't say just copy paste. Of course, principles remain same now. What is inventory at international level will remain inventory at India also. Na? You can't say no, in India we have different thing. No, it's same. Assets held for sale. So don't think that way that if IFRS is this, IND AS is this. No, it's not that. They are all on same page. But in order to accommodate with Indian environment, business culture, Indian laws, we prepared our own set of standards which were converged form of IFRS. That is nothing but referred as IND AS. Clear, dear students? See, financial reporting is a subject which deals with reporting of financial transactions and financial statements of corporate entities, joint stock companies, banking companies, insurance companies and NBFCs. Yes, globalization, liberalization, we have become an economic village. The attendant structures, regulations which support it, as well as development of e-commerce market, make it imperative to have a single globally accepted financial reporting system. The use of different accounting framework in different countries which requires inconsistent treatment and presentation of same underlying economic transaction creates confusion for the user of financial statements, of course. Because now you are a global investor. You not only invest in India, cross-border investments you are doing. So as a user, it leads to confusion. And this gives inefficiency in capital markets. Therefore, increasing complexities of business transactions and globalization of capital markets call for a single set of high quality accounting standards. That is nothing but IFRS. That is how IFRS came. Now, what are IFRS, friends? IFRS are international financial reporting standards which are issued by IASB, which is based in London. Till date, how many standards have they given? If you look properly, till date they have given 25 international accounting standards from IAS 1 to IAS 41 and 17 international financial reporting standards from IFRS 1 to IFRS 17, both referred as IFRS. Yes, that's why I said, when I say IFRS, friends, I'm talking with respect to IAS plus IFRS. Yes, but if any area is dealt by IFRS, then the related IAS stands withdrawn. Then the related IAS stands withdrawn. So if I say IND AS 110 consolidated financial statements, the related IAS is now withdrawn. But if an IFRS is not made, because we have only 1 to 17 as of now, if related IFRS is not made, then of course IAS will prevail there. Okay, so what are those IND AS? Indian accounting standards are set of IFRS converged accounting standard. This IND AS are converged with corresponding IFRS, as India has taken an approach of convergence rather than adoption, making some significant changes known as carve out while converging. Carve out means principally conceptual difference, yeah, with IFRS, and carve in terminology changes, restriction of option given in IFRS. Now friends, of course you have your index, so I need not worry with respect to what we are going to study in the coming days, but then also I would just like to give you an idea with respect to what are those indices which are there in our syllabus. One by one, I'll just write down those indices. Like index 1, presentation of financial statements. Index 2, inventory valuation. I'll just use the standard word only, inventories. It does not use the word valuation. Statement of cash flow. Now don't worry, where 3 is there, the corresponding IAS stands by drawn. Hence, directly index 7. Index 8. This is all in your syllabus, accounting policies. Changes in accounting estimates and errors. Thereafter, friends, index 10, events occurring after the reporting period. Construction related index stands withdrawn. That was nothing but 11. Yeah, that has been withdrawn because index 115 has been brought into picture. Index 12, income taxes. Clear, students? So we have a standard on income taxes also. Then index 16, property, plant, equipment. I hope, of course, for examination purpose, this is not important, but you should be aware with respect to the name and the number. Yeah, nobody is going to ask you in exam which number of which index is there, friends. Then index 19 is nothing but employee benefits. Accounting for a government grant, and the name is big, and disclosure of government assistance. I'm just restricting myself to accounting for government grant. So these are the index which is there in your syllabus, and this all index have become chapters for us. So each index is a chapter. The effects of changes in foreign exchange rates. Ind AS 23 borrowing cost. See, many words, many stuff you'll find they are similar. Of course, whatever was there in your AS, that only goes further. Of course, at final level, we learn something in more depth. Borrowing cost is borrowing cost. What you learned in AS 16 is still there in under Ind AS 23. Principles will not change with respect to whatever you have learned, capitalization and all those things. But some discussions, some points in depth we will study, and that too from the perspective of Ind AS. Okay, see, if you're writing, I don't mind, but you'll find that your index page, this all Ind AS are there. But of course, in index, they have been chronologized in such a manner of studying. Which should you do first? Yeah, here I am writing only on the numbers based. Ind AS 24. Related party disclosures. Ind AS 27. Separate financial statements. Now this is going to play a vital role. It is nothing but something which we will be doing with respect to consolidation only. Means when we study consolidation, at that point of time, separate financial statement concept we will be learning. Investment in associate and joint venture. Yeah, again this is consolidated related standard. Ind AS 33, earning per share. You studied something referred as EPS. Yes. Journey continues, friends. There is no big area of difference except for the reporting standards will change the paradigm of looking, where more focus will be through fair value rather than historical costs. Interim financial reporting. Impairment of assets. Provisions. Contingent liabilities. And contingent assets. Ind AS 38, nothing but intangible asset, friend. I'll take you in the next page if you're writing. Okay, so thereafterwards, Ind AS 40, investment property. Then we'll be studying Ind AS 41, which is with respect to agriculture, friends. Now you will always find thereafterwards I have Ind AS where you will find 3 digits, like from here onwards. Ind AS 101. First time adoption of Ind AS. The reason is very simple. Where it is 2 digit, the corresponding Ind AS means when an Ind AS is a 2 digit, the corresponding IFRS is IAS. And now when we have 3 digits, it's nothing but corresponding is IFRS. So you will find IFRS 1, IFRS 2, share-based payments. Business combination. There is Ind AS 104, but it is not there in your syllabus, so there is no need to do it. Ind AS 105, non-current asset held for sale and discontinued operation. Yeah, that is nothing but our Ind AS 105. Thereafter, friends, Ind AS 106, not there in our syllabus, so I'm not writing also. Ind AS, I'll write 108 and then related to financial instrument standard, I'll just combine all of them. That is operating segments. I'll just write all of them together. Ind AS 32, Ind AS 107 and Ind AS 109. Of course, the name are different: financial instruments, disclosure, financial instrument presentation, and all these things. I'm just using this. These are nothing but my financial instruments related standard: 32, 107 and 109. Okay, so after 105, I directly went for 108. The reason was I'm going to take here Ind AS 110, consolidated financial statements. Consolidated financial statements. Ind AS 111, joint arrangements. Ind AS 112, disclosure of interest in other entities. Ind AS 113, fair value measurement. Ind AS 114 is not there in your syllabus only, friends. Ind AS 115, nothing but revenue from contracts with customers. Ind AS 116, leases. So friends, these are the standards which you have to study. Yeah, I just wrote down the name, not important for examination that they will going to ask you questions and answers what is the name. Just but you have to remember the name, because sometimes when we will be discussing, like when I'm discussing in day 16, along with that I will say under in days 36. So that is nothing but I'm talking with respect to impairment. Yeah, so linkages are there. You'll find so many linkages. Like when we are discussing business combination, we will link it with Ind AS 12 also, deferred taxes. Same way when we are doing deferred taxes, we'll link it with 102. Yeah, then we'll link it with 110 also, and so on. So don't worry at all, nothing to worry. But what I mean to say, when we studied that standard at that point of time, you remember the name, that is okay. But before that also you should know that we are linking with what. It's not necessary every time I'll say under Ind AS 102 share based payment we do this. I'll say as per Ind AS 102 this is happening and this is the link. Okay friends, an example with respect to this module. Company A, Company B are in power business. Company A holds 25% equity shares of Company B. On November 1st, Company A obtains control of Company B when it acquires further 65%. So you already have 25% and then you are acquiring 65%. So 90% stake. So can I say it is nothing but step acquisition is happening? Yes. So business combination is achieved in stages. The acquisition has following features. Okay. The consideration, Company A transfers the cash of 59 lakhs and issues 1 lakh shares on November 1st. The market price of Company A share on the date of issue is 10 per share. The equity shares issued as per this transaction will comprise 5% of the post-acquisition equity capital of Company A. Contingent consideration, Company A agrees to pay additional consideration of rupees 7 lakhs if the cumulative profits of Company B exceed 70 lakhs over the next 2 years. At the acquisition date, it is not considered probable that the extra consideration will be paid. The fair value of the contingent consideration is determined to be 3 lakhs at the acquisition date. Okay, so the fair value is 3 lakhs. Transaction cost, Company A pays acquisition related transaction cost of 100,000. The non-controlling interest. The fair value of NCI is determined to be 7,50,000 as the acquisition date based on market prices. Company A elects to measure the non-controlling interest at fair value of this transaction. Previously held non-controlling interest. Company A owned 25% of the shares in Company B for several years. At November 1, the investment is included in company as consolidated statement of financial position at rupees 6 lakhs accounted for using equity method. The fair value is 20 lakhs. The fair value of Company B's net identifiable asset on November 1st is 60 lakhs determined in accordance with Ind AS 103. Determine the accounting under acquisition method for the business combination by Company A. Friends, a good comprehensive question I would like you to read. Yes, one thing, it is nothing but a business combination which is achieved in stages. Clear? Now, consideration. And thereafter you will read this part. And friends, then we have this required. Now, first of all, can I say we discuss one by one? Identify the acquirer. Yes, my dear students. Who is the acquirer? Identify the acquirer. Can I say company A is the acquirer? Not from this question. I'm not taking it from here. I'm taking it because company A transfers cash off. Acquirer is entity which transfer cash or equity interest. And then see, even after transferring our equity interest, company B will not get control over company A. The shareholders of company B are not going to get control over company A because it is only 5%. It means company A is the acquirer. Company A is acquirer. Company B is acquiree. Second, date of acquisition. What is to be done with respect to the date of acquisition? Do you remember? That is the day when you get control. So my dear students, you already had 25%. On November 1, company A obtains control on company B when it acquires 65% of the company's B shares, thereby resulting into total holding of 90%. So, 1st November should be considered as date of acquisition, as that is the day on which company A obtains control over company B. Identifiable net assets. What are the assets taken over by you? Identifiable net assets. Yes, friends. So this point was there. This is nothing but consideration, contingent consideration, transaction cost. The fair value of B's identifiable net asset 60 lakhs. They have just given us directly. Identifiable net assets 60 lakhs. Then what is the purchase consideration? What are the things you are going to give in purchase consideration, my dear students? One by one, read it. First I found out the acquirer, then I found out what is the date of acquisition, then the third thing is nothing but identifiable net assets, and now purchase consideration. So my purchase consideration is nothing but you are transferring cash. How much is the cash you are transferring, friends? 59 lakhs. Are you transferring only cash? No, friends. You are also issuing 1 lakh shares. Equity shares in company A. 1 lakh into rupees 10. 10 lakh. Anything else you are giving? Contingent consideration. You agree to pay 7 lakh if the cumulative profit is 70 lakhs over the next 2 years. At the acquisition date, it is not considered probable that the extra consideration will be paid. The fair value of contingent consideration is 3 lakhs. Now,
One more thing, and that is, friends, previously held controlling interest. Now this is nothing but we are getting control, not in one go. We are getting control in stages. And when it is in stages, do you remember that whatever previously investments are there, they have to be brought at our fair value. Yeah, that is nothing but 60 lakhs. I will do journal entry, so don't worry. Fair value of previously held interest. How much it is the fair value is? ₹20 lakhs. ₹59 lakhs plus 10 lakhs plus 3 lakhs plus 20 lakhs. That is nothing but 92 lakhs is my consideration. My net identifiable asset is 60 lakhs. Now, fifth area. Non-controlling interest. What is my non-controlling interest? Obviously, it is to be recognized. Which method? At fair value. What is the fair value of my NCI? 7,50,000, friends. Clear? Now calculation of goodwill or capital reserve. So what we have, purchase consideration. What is the purchase consideration, dear students? 92 lakhs. Clear? Plus NCI at fair value 7,50,000 plus previously held equity interest 20. Oh, that is already included. I'm sorry. I've already included in 92 lakhs, including previous interest. Yes. So I can directly say 99,50,000 less identifiable net assets. What will be happening to your identifiable net assets, friends? Identifiable net assets, nothing but the amount was 60 lakhs. $39,50,000. Now I will pass entry so that you understand how the flow of the transactions are going to happen here. Yeah, first, very simple, the question, identify the acquirer for this. Yes, nothing but we are getting control in stages. So identify the acquirer. A is acquirer, B is acquiree. 1st November, identifiable net assets, the value is 60 lakhs. See, if NCI would be at proportionate cost, proportionate value, then 60 lakhs into 10% we would have considered. Purchase consideration, cash consideration, equity shares, contingent consideration, fair value of previously held interest, 92. Thereafterwards, non-controlling interest not at proportionate share in net asset, but at 750. So how did I found out my goodwill? Cash consideration 92, NC at fair value 750, and then identifiable net assets goodwill. Now let's go for journal entry, my dear students. Separate financial statements. In this separate financial statements, friends, can I say investment in company B appears at cost, I can say. Yes, which is not known. But in consolidated financial statements, it is appearing at 6 lakhs. Okay. So at cost, not known. You again buy. So what will be your entry? Investment in company B, account debit, to cash, to equity share capital, to provision for contingent consideration. How much did you agree to pay in cash, friends? Can I say in cash you have agreed to pay 59 lakhs? Equity shares, 1 lakh shares of rupees 10. So it's 10 lakh, and the fair value of provision 3 lakhs. So now both of them will be added together. Investment in company B appears at cost. We don't know. This is 25%, and this is nothing but 65%. Yes, friends? Now we come to our consolidated financial statements. In consolidated financial statements, friends, what is going to happen is nothing but investment in company B, that is nothing but 25% part, carried based on equity method at, it is carried at what value, friends? If you look properly, you will find 6 lakhs. So now when the day you get control, you will bring it at fair value. So my entry will be investment in company B to profit or loss account. What is the fair value today, friends? It is 20 lakhs. It was at 6 lakhs. So can I say there will be an increase of 14 lakhs? Now this is nothing but remeasurement of previously held interest. Thereafterwards, identifiable net asset account debit. You can take it from here itself. 60 lakhs. To cash 50 lakhs to equity share capital, friends, 10 lakhs to provision for contingent consideration, it was 3 lakhs, I hope you remember, to investment in company B, 20 lakhs. I hope, how did I get this 20 lakhs, friends? Friends, I already had 6 lakhs plus 14, 6 plus 14, yeah, that is nothing but 20 lakhs. And to non-controlling interest at fair value. What was the fair value of non-controlling interest? It was at 7,50,000. Oh, cash was how much? 59. I'm sorry. I made an error. Cash is 59, friends. Hmm, 59. See, basically nothing but the balancing figure here. 39,50,000. This is nothing but goodwill. Yeah, this is nothing but the entry to be passed in consolidated financial statements, friends. Yeah, in accordance with our IND AS 103. Now you will say, sir, what about that acquisition cost? Because if you look properly, I have covered everything. This 25%, 65%. We have spoken on this. Consideration 59 lakhs was taken, 1 lakh into 10, that was 10 lakh. This was with respect to whether it is reverse acquisition. We said no, company B shareholders are not getting any control over companies A. Contingent consideration, of course, 3 lakhs. Transaction cost of 1 lakh. It should be recognized in profit or loss. Non-controlling interest, we took it. This point is left out. I'll just write a note for it. Yeah, non-controlling interest, 750. Previously held non-controlling interest. Okay. So this 6 lakhs was nothing but in consolidated financial statements valued at 20 lakhs. So the difference of 14 lakhs recognized in profit or loss account. This was nothing but identifiable net assets, friend. So 14 lakhs gain has been recognized here. Now, friends, note with respect to the acquisition. For acquisition of company B will be debited to profit or loss. Yeah, so 1 lakh rupees, 1 lakh. Profit and loss as an expense. Yeah, clear, my dear students? So this is the end. Of course, you are very much eager to write the solution. You may start writing it one by one. the first part. You just have to pause the video, friends. The first part. Pause the video and write it down. Second part. Okay, now friends, calculation of goodwill. This 92 lakhs I've just combined with respect to previously held interest. What I should have done would be more appropriate. I should have written the purchase consideration plus the 20 lakhs independently. Then also it is okay. These are the journal entries. They will pass in separate financial statements, friends. In this case, if you look properly, I don't know how much is the cost. 65% is acquired at 72 lakhs because we paid 59 lakh cash, 10 lakhs as equity shares and provisions for contingent consideration. Consolidated financial statements, you already have this at 6 lakhs. I remeasure it, so pass this entry, friends. That is a remeasurement entry, and then last entry is with respect to this. Basically 2 entries will be passed in my consolidated financial statements. And of course this small.
So now let's move on to what we are going to study here. The second area is nothing but meaning. Basically, what is a financial instrument? So friends, a very basic definition it is, a financial instrument is any contract. See, it's a contract. Not necessary it has to be written. It should be a contract. And what does this contract give? This gives rise to financial asset of one entity or financial liability or equity of another entity. So first of all, if it is a contract, obviously there will be at least 2 parties to that contract. And contract, it means it is enforceable. It will have some kind of economic consequences. Yeah. So it is a contract. It gives rise to financial asset for one entity and financial liability or equity for the another. Means there are 2 persons basically, minimum. For one person, it should be a financial asset, and for the other person, it should be a financial liability or it should be equity. Clear? So very simple. Now your doubt will come, what is financial asset? What is financial liability? Let's come to that point later on, because standard has given us what are components of financial asset. But if I say it gives rise to financial asset for one entity and financial liability to another, it means, say we have A Limited, Z Limited. A Limited issued debentures, Z Limited purchased that debentures. So basically, this contract, investments of A Limited, investments in A Limited, investments in debentures of A Limited, Z has invested. Okay. So now friends, this is nothing but a financial instrument. This debenture, the document, whatever document, it may be in dematerialized form, that is, even though it's contract, this document is giving rise to financial asset for Z Limited. For them it is a financial asset, whereas for A Limited it is nothing but a financial liability. Yeah. Coming on to some example for just understanding. Mr. B purchased debentures of ABC Limited. Don't worry as of now. Don't think, sir, what is financial liability? Don't worry as of now. I am going to come on it. Whatever examples are, just understand this is a financial instrument. Yeah. Mr. B purchased debentures of ABC Limited. Now, if Mr. B has purchased debentures of ABC Limited, for Mr. B, it is nothing but a financial asset. Whereas, for ABC Limited, it is nothing but a financial liability. Hence, it is nothing but a financial instrument. Just to add something more, Kavita acquired 100 equity shares of Karan Limited. So Kavita is buying shares of Karan Limited. So for Kavita, it is financial asset, and for Karan, it is nothing but a equity. That's why the definition was very clear. Repeat this definition. What is a financial instrument? Financial instrument is a contract, which gives rise to financial asset for one entity and financial liability or equity for the another entity. It's not financial liability as well as equity. Either financial liability or it is financial liability or it is equity. It means here it is asset. So here it can either be equity or it can be a liability. Clear, friends? So this is what is all about a financial instrument. Now let's come to the most important part, because we said financial instrument is a contract which gives rise to financial asset for one entity. What is that financial asset? Standard makes it very clear. It says only 4 things. This financial asset can be cash. Cash is financial asset, final. Of course, it gives you a right of exchange. Cash is a financial asset, number 1. Then, number 2, an equity instrument of another entity. You are having equity instrument of another entity. That is also financial asset. See, the standard is not defining financial asset, but it is just giving us an idea. Cash is a financial asset. Equity instrument of another entity is also a financial asset. Similarly, contractual right. What is this contractual right? Contractual right, 2 things. To receive cash or another financial asset from another entity, like somebody is my debtors, bills receivable. So don't you think I have a contractual right to receive cash or financial asset from another entity? Some other financial asset I will get, but I have a right to receive cash. Investments and debentures, they will be redeemed. So when they will be redeemed, what will happen? I will get cash. Or investment in convertible debentures, it will get converted. So what I will get? When debentures will get converted, I will get equity shares. That is another financial asset. Because here only we wrote, what is financial asset? Cash, equity instrument of another entity. It is an equity instrument of another entity. Clear? Contractual right to receive cash or another financial asset from another entity, obviously. The next, what is the contractual right? Contractual right to exchange financial asset or financial liabilities with other entity under conditions that are potentially favorable to the entity. Let me give you a basic example. Options. I hope under SFM you would be aware of the term option contract. Yeah, what is an option contract basically? An option contract is a contract where the holder has a right either to buy or sell an underlying asset at a predetermined rate and predetermined date, but he is under no obligation to exercise. Means the holder has a right. Like I enter into a contract with you wherein I say after 20 days I will buy shares of XYZ Limited if I want to buy. Means I am under no obligation to buy. If I want to buy, so obviously when will I exercise my option? Only if it is favorable to me. The agreed price is 20, the market price is more than 20, so obviously I will exercise it. But I am under no obligation to exercise. If the price is less than 19, I will say okay, let the option lapse. So friends, the standard is talking with respect to contractual right. What is that contractual right? To exchange financial asset or financial liability
in conditions which are potentially favorable to me. Now, when can it be potentially favorable? Can I say under option contract, I am the holder of that option? Then obviously, the terms of contract are favorable to me. If the price goes up, it is favorable. If price goes down, I don't exercise. Then also, the contract terms are favorable to me. Hence, to exchange financial asset or a financial liability with another entity in conditions that are potentially favorable, even that contract is a financial instrument. So friends, we will also be discussing about derivatives, because option is a derivative. Of course, we will not jump now upon all those derivatives, but how accounting should be done for it, that we will be learning here. Yes. So, what is a financial instrument we were discussing? What was a financial instrument? Speak up every time so that you can remember. Asset for one entity, liability or equity for the another entity. What is asset? Can I say financial asset? Basically 4 things. Number 1, it is cash. Flat cash is a financial asset. Number 2, equity of another entity. Number 3, contractual right to receive cash or financial asset. Yes, that was nothing but debtors and all those things. Then contractual right to, it's not receive, contractual right to exchange financial asset or financial liability in conditions or the terms of the contract are such that they are favorable to me. Potential right to exchange asset or financial liability with other entity under conditions that are potentially favorable to us. The 4th area. Basically, this 4th area from our Indian context is not there only. Yeah, as per Companies Act, this is not allowed only, but only for our discussion we will discuss, because standard has not closed down this area. The 4th is, this is also financial asset. A contract that will be settled in entity's own equity instruments. Means what? I have a contract, and under that terms of contract, I am going to get my own equity shares. So, if I am XYZ Limited, I have entered into a contract with some ABC or whosoever it may be, and that contract envisages that I am going to receive shares from that ABC, and that shares will not be somebody's else share, that share will be my company shares. I will be receiving my own equity shares. So, contract that may be settled in entity's own equity instruments, and that contract is non-derivative. Like, I will give you my land and you give me 200 crores worth of my shares. So, basically somewhere variable number of shares, or a derivative kind of contract. Yeah, in sense the number of shares are fixed. Here I said I will give you land and you give me 200 crores worth of my shares. So, how many shares? 200 crore worth of shares. Number of shares are variable here, I can say. So, I said is nothing but a non-derivative. And when I said derivative, in sense, the number of shares which I am going to get is fixed. I will issue you my property on some point of time, and you give me nothing but my 20,000 equity shares. Of course, both of them, legally this is not available in this country. This option means under the Companies Act, a company can buy its own shares only if it is under a scheme of buyback. And I hope you remember those sections you would have studied in Inter. Under buyback only you can buy, and that too you have to dispose it of within 7 days physically and all those things. So, dear students, what standard says is nothing but you are having a contract, and that contract gives you a right to receive your own equity instruments. That is a financial asset. Yeah. So, we were discussing about what is a financial instrument. So, we said it's a contract. So, 2 parties were there. This contract is giving rise to financial asset. Now, this financial asset can be cash, It can be equity or a contractual right to receive cash or financial asset, or contractual right to exchange financial asset or a liability in conditions or the terms of the contract are potentially favorable to me, favorable to the a person who is holding that right, or a contract that will be settled in the entity's own equity, where you get fixed number of shares or variable number of shares. Of course, for examination point of view, you are learning, but practically you will find this fourth option, treasury shares. In India, in our country, that is not possible. Yeah, so that is financial asset. Now, I am just giving you an idea with respect to this. These are not to be considered as financial asset. Of course, physical assets, inventories, property, plant equipment, leased asset, intangible assets such as patents, prepaid expenses, income tax refund, because it does not arise due to income tax refund, does not arise due to any contract. It is a statutory obligation. I haven't entered into a contract with the income tax people. Yeah. So, these are not to be considered as financial asset. Now, we come upon what is financial liability. Financial asset, friends, we had 4. Here I have 2 of them. What is a financial liability? A financial liability, see, cash and equity, you just forget that. Remaining to what was there in financial asset, the same thing is here only. Yeah. So, point number 3 and point number 4 of financial asset is nothing but point number 1 and 2. These 2 things are not there. This 1 and 2 is not there. This 1, 2 is not there. 3 and 4 is obviously financial liability. So, here you had contractual right. So, if it is a liability, then what should be the reverse of it? Contractual obligation, obviously. Yeah. So, what is the financial liability? Nothing but a contractual obligation. And what is this contractual obligation, my dear students? To do things. To what 2 things? To deliver cash on another financial asset to another entity. I am under an obligation to deliver cash, like I have issued debentures. So, obviously, I am under an obligation to deliver you cash, or it is convertible debenture, whatever it may be, but it is nothing but a financial liability. Of course, with respect to convertible debenture, we will talk later on. We cannot directly comment it is 100% financial liability, but I have to deliver you something. You are a debenture holder. I say, okay, I will give you cash, or I say, I will give you my investments against this debenture. So, that is nothing but financial asset. Deliver cash or another financial asset to another entity, or contractual obligations to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable. The conditions are unfavorable to me. Now, friends, when can the conditions be unfavorable to me? Same in option contract, I am the writer of option. Under an option contract, I am the writer of an option. So, if I am a writer of an option, obviously the conditions will be unfavorable to me. Other person has a right to buy. Other person has a right to sell. I can't say, no, you sell only. No, he says, I have a right. I may exercise my right. I may not exercise my right. I may sell, I may not sell. So, when will he exercise the right? Only when there is profit to him. Only on exercise, it is beneficial to that person. Of course, for entering into such contract, we get some compensation referred as option premium. Not going in those areas now. But understand, friends, you do a contract with me. You say, sir, we will buy 100 shares from you on this date if we want to buy. See the word, if we want to buy. So, you may buy, you may not buy. And you will buy only when you are into profit, you are going to earn from it. So, the terms of the contract are obviously unfavorable to me. See, whether the contract gets exercised or it does not get exercised, the terms of the contract are not favorable to me. Hence, to exchange financial asset or financial liability with another entity under conditions that are potentially unfavorable. See, there we had conditions which are potentially favorable. That's why I said option contract, I am the holder of that contract. Here I am the writer of that contract, friends. Thereafterwards, financial liability. What is the financial liability? A contract number 1 is nothing but an obligation to deliver cash or deliver or exchange financial asset or financial liability in conditions which are potentially unfavorable. Second, a contract that will or may be settled in entity's own equity instrument. Now friends, don't say this is also not covered by, no, this is covered. Companies Act prohibits us to receive our own share. Companies Act does not prohibit us to give our own shares. I can obviously issue my shares. There is no embargo with respect to I issuing my shares. So this second area, friends, is nothing but with respect to a contract that will or may be settled in entities' own equity instruments, and that can be a non-derivative or a derivative, where I say I will purchase something from you. There is a contract where I will purchase something from you and I will issue my equity shares. If the number of equity shares is fixed, we say it's nothing but a kind of derivative there. Of course, don't go with the term of derivative or a non-derivative. It means I'm going to issue some variable number of shares. I say I will be issuing you 20 lakh worth of shares. So it depends on the market price on the date of exercise. So the number of shares are not fixed. And here I say the number of shares will be fixed. Clear, friends? So you are on financial instrument. We defined financial instrument. Then within that we got financial asset for one entity and financial liability for another entity, and obviously equity. Now I am just speaking, we'll come on equity also there. But basically what is equity here? Nothing but residual interest. So as of now, don't think when I say equity, I'm talking about equity shares. Normally it is always perceived equity shares, but don't think it is equity. Equity share capital is part of equity. I can say it's residual interest. Yeah. Now, some of these examples which are not financial liability, income tax payable, all the statutory obligations. Yeah, they don't arise because of contract with any statutory authorities. Yeah. Provisions for warranties. Why not covered? Because to become a liability, it has to be settled in cash or a financial asset. What I am going to do? I am going to give you services and goods. Advance from customers, advance from customers. Obviously, in this case, what will we be doing? We'll be supplying goods and services. So obviously, even this is not a financial liability. Non-controlling interest. Yeah, in consolidations, you would have come across that non-controlling interest. Non-financial contract, non-financial derivative contract, just a gist of those contract which are not considered as financial liability. Now, just a small area. It is to be noted that commodity exchange contracts required to be settled by delivery of commodity and not financial instruments like I enter into a contract where I say I will buy 10 kgs of sugar. So basically sugar is not a financial asset. I will buy gold. So gold is a commodity there. So it's not a financial asset. But friends, that doesn't mean gold bonds are not financial asset. Because I sell off the bonds, I get cash. So financial asset is nothing but contractual right to receive cash. But here I am doing a contract where I am going to get delivery. Then obviously, if that delivered item is not financial asset, then the contract is not a financial asset. But a commodity contract which will be net settled. I hope you understand what is net settlement and gross settlement. In derivatives chapter, you would have come across that. Gross settlement means what? Physical delivery happens on the decision making day. And net settlement means what? Only differences. This is the agreed price, this is total today's price. Difference you pay off. That is net settlement. Like I say, I will buy gold at 40,000 rupees.
Today the gold value is 50,000. So you just give me 10,000. Things are over. This is known as net settlement. But if I say gross settlement means what? I will actually give you 40,000 rupees. You will give me that 10 grams of gold. So if it is gross settlement, if I am going to take physical delivery, friends, then it will not be covered by this standard. But if it is net settlement, then of course it will be included in the definition of financial instrument, because when it is net settlement, obviously contractual right to receive cash and their contractual obligation to deliver cash. So financial asset for one entity, financial liability for another. Yeah. Now, coming on to within this financial liability, I am discussing some areas. Yeah. See, till intermediate, we were always coming through preference shares, and if you remember, this preference shares were always classified by you under share capital. Now, under this financial instrument standard, we look at the substance rather than the legal form. Obviously, at all Indies, our whole thinking is substance rather than looking at its legal form. So, what is to be done with respect to redeemable preference shares? Dear friends, it's not shocking for you, I hope so now, because if you look at the definition of a financial liability, can I say a redeemable preference share, a redeemable preference share actually falls under the definition of financial liability, because you are going to pay off. From our Indian context, the maximum period is also fixed. So you are going to take up. So some financial instruments take legal form of equity but are liabilities in substance. Yeah. So preference shares are liability, but obvious, as we move forward, I have a separate discussion with respect to preference shares. Just because I was talking about financial liability, I have just given reference of redeemable preference shares. They are financial liability. Look at the substance. Another area, puttable instruments. Now, what is puttable instruments? Just a basic idea. It gives a right to the holder to give you back and ask for money. Put it back. Like units in a mutual fund. Of course, they fall under equity because exceptions are there. But if such kind of instruments are there, which gives the holder a right to give back, like in a mutual fund, what do you do? See, on understanding, I am saying a mutual fund. Basically, it gets classified as equity there. And why? Because there is an exception, we will learn now only. But I am just making you understand, when I say put it back, give it back. A puttable instrument is nothing but a financial instrument gives the holder the right to put the instrument back to the issuer. Like we were issued some units. What do? If we have some good amount of capital appreciation, don't you think we sign up a form and we say we want to give back these units? We say redemption of units. Nothing but a kind of financial instruments which we are giving them back and getting cash. So friends, that is nothing but puttable instruments, right to put back to the issuer for cash or another financial asset. And of course, because of this, the issuer of this puttable instrument is always under an obligation. What is the obligation for that issuer of that puttable instrument? He has to pay you cash or any other financial asset. So it's nothing but a financial liability. But there is an exception to it, friends. If following conditions are getting fulfilled, then even though we say a puttable instrument is a financial liability, it will be classified as equity. That's why I said the mutual fund units. Yeah. Like what are those conditions? I can say investor specific and issuer specific conditions. If these conditions are specified, then even though they are puttable instruments, friends, they will be classified as equity. Now, what are those instruments? Like, though they are puttable, it says the holder is entitled to pro rata share of entity's net assets on liquidation. So obviously till the end I am there with the entity. I am entitled to some net assets on liquidation.
Yeah, putable instrument is subordinate to all other classes of instruments. Means the claims of all other instruments would be taken first. We are subordinate to it. Second part. All instruments in this class have similar identical features. Contractual obligation shall not be under potentially unfavorable conditions to the entity, and the last is the very important. The expected cash flows is based substantially on profit or loss, or change in recognized net assets, or change in the fair value of recognized and unrecognized net assets of the entity over the life of the instrument. See, the mutual fund. I am a holder of an equity mutual fund. What is happening? They are putable. That's why they use the word open-ended scheme. Whenever I want to give them back, I can give them back. But friends, if you look properly, don't you think my cash flows are totally dependent on the profit and loss, the gains made by them? Maybe realized, maybe unrealized, the changes in the net assets. On that depends my cash flow, the quantum of dividends, what they will pay, the capital appreciation, what I will get. So basically, I have 5 conditions with respect to the putable instruments. If these putable instruments are having these conditions, then they will be considered as equity. Yeah. Similarly, from issuer angle, there are 2 conditions. Obviously, have no other financial instruments or contract that has total cash flow substantially based on profit and loss changes in recognized net assets. Same thing. What was the last condition there? Similarly, the issuer should not have any other contract wherein the cash flows are dependent on changes in the value of assets. Yeah. The effect of substantially restricting or fixing the residual return to putable instrument holder. Yes, friends. From accounting angle, we will not be focusing more on this, but we are just going on what is a financial liability. So there were 2 things: contractual obligation to deliver cash or financial asset, contractual obligation to exchange financial asset or a financial liability in conditions which are potentially unfavorable, and the contract that may or will be settled in entities' own equity instruments. Then when we are talking about financial liability, friends, I just went in 2 areas. First is nothing but redeemable preference shares. We are just questioning, are these preference shares equity or should it be considered as liability? So our standard is obviously focusing on substance. So we said, of course, redeemable preference shares, you have an obligation to deliver cash within some period of time. So they are obviously financial liabilities. Similarly, putable instruments, where the holder is having a right to give me back. Holder says, I will give you back and you give me cash. Then these putable instruments are obviously financial liability. But our IND AS talks about an exception to this rule. It says, yes, putable instruments are financial liability. 110% putable instruments are financial liability. But if they are fulfilling these conditions where you have right to net assets on liquidations, yeah, they are subordinate to all other classes, then all instruments in the class have identical features. My cash flows are dependent on the profit and loss whatsoever it may be. So if this type of conditions are there in that instrument, then this putable instruments will be classified as equity. Clear? So just for our understanding purpose, now what is equity? I'll just not show you the examples. Equity, a contract that evidences residual interest. After everything is settled off, whosoever are left out are nothing but equity. See, it's not necessary. Generally, ordinary shareholders are the only people who are left out. After paying off all the obligations, settling all these liabilities, whatever assets, may be positive or negative, whatever is left out, that contract, that whatever is left out belongs to me. The owners, the real owners, you can say, that is nothing but equity. Yeah, it is a contract that evidences residual interest in the assets of an entity after deducting all its liability. It means equity instrument holder is the owner and who is ready to accept remaining money after clearing all the liabilities of the entity. Remaining amount may be positive or nil also. Of course, non-puttable ordinary shares. Puttable instruments are also equity if not financial liability and specific conditions, those 5 conditions. Yeah, instrument specific and issuer specific. Instruments imposing obligation to deliver pro rata shares in net assets only on liquidation. Of course, if not financial liabilities. Preference shares, of course, they are also equity when distribution is at the discretion of issuer and not mandatory. Warrants or written call options. So, basically I am just giving you an examples with respect to equity. This all things can come under equity.